Hi everyone. In today's lecture, we will understand what is a future contract and a forward contract. We will cover this chapter in three parts basically. One is the foundational concepts, where I am going to explain you the asset classification and the fundamentals of the contracts. And in part two, that is pricing theory, we will do some mathematical derivations and arbitrage relationships. And finally, in advanced applications, we will cover currencies, commodities, and other portfolio strategies. So, what is an investment and what is a consumption asset? So, we will differentiate between an investment asset and a consumption asset before getting in to a detailed analysis of the futures and forward contracts. The classification of the assets as a investment asset or consumption asset, it will have a very far reaching implication on the way we are going to derive the price derivative contracts. Actually, investment assets are those assets which are held primarily for the investment purpose by a significant number of investors. Large investors like foreign portfolio investors, foreign institutional investors, mutual funds, they all hold assets. So these type of assets which are held by big institutions generally come under the purview of the investment asset. See, what are the types of investment assets? Basically, it includes stocks, bonds, gold and silver. So why investment assets are there? It is there to get some financial return, and investment assets are generally liquid because there is a secondary market which exists. What is a secondary market? Secondary markets are those markets where you can buy and sell the financial assets like stocks, mutual funds, gold, silver, or anything. So we can generally observe the market prices of these financial assets. As we have national stock exchange, we can see the what is the price variation which is happening in the market with respect to your stocks or with respect to your mutual fund net asset values and everything. So generally investment assets will have an observable market price. You can track the prices of these assets on a daily basis, or even hour to hour basis you can track it. Here arbitrage relationship holds precisely. See, relationship holds precisely means there will be no arbitrage opportunity in these type of investment assets. Okay, if there is an arbitrage opportunity, then people will make riskless profit. We will describe what is an arbitrage in future slides. So now let us come to the consumption assets. What are consumption assets? Consumption assets are the assets which are held primarily for consumption rather than for investment. Most of the commodities which we have, like oil, natural gas, liquefied natural gas, LPG, and agricultural commodities, they all come under the consumption assets category. What is the characteristic of the consumption asset? Basically, it is valued for utility in production. It means most of the consumption, like it can be copper or anything, it can be used in production. Here consumption assets, which are basically commodities, the storage costs are very significant and it may occupy large amount of storage, which may require insurance, fire protection and other aspects. Here the convenience yield matters. We will describe what is a convenience yield means. Convenience yield is nothing but the benefit of holding an consumption asset with you whenever there is an acute shortage of these consumption assets. So that is called as a convenience yield. Here in consumption assets you don't find much leverage for arbitrage. There will be very limited arbitrage opportunities available. Now let us understand what is a forward contract, and we will understand the structure and mechanics of a forward contract. See, a forward contract is nothing but it is a customized contract between two people. are two individuals or two traders. It is generally an over-the-counter agreement happening between two private people, one agreeing to buy a particular product on a particular date and the other person agreeing to deliver a particular product on that particular date based on the a particular price which are determined. Now, when the forward contract happens, there will be no exchange of either the product, or there will be no exchange of the money in which is involved or which has been agreed upon. So the exchange happens only at the end of the contract period or the termination of the contract period. So, what are the key characteristics of a forward contract? First of all, it is a bilateral OTC agreement. It means it is an agreement between two people. OTC means over the counter agreement. Secondly, it has got customized terms and condition. It means, see, if two people are coming to an agreement to buy and sell, they can have any terms and conditions between them, uh, and they can tailor those terms and conditions depending upon how much to products that he is going to buy, how much money that they are going to pay, what are the terms and condition in respect of delivery. So all these things will be customized between these two, buyer and a seller. That is why the characteristic is called as it is a customized terms and condition. Now, here as I have described, two persons agreed, one to deliver a product and another to buy that particular product. There is no initial payment which is made. The payment is made only at the end of the contract period. So, this is settled at maturity. Here, the counterparty credit risk is available or it is present. Why? Because suppose let us assume a person who has agreed, since there is no transfer of money between these two persons or transfer of the product between these two persons, nothing is at stake. So tomorrow, if a person who is agreed to buy a commodity, for example wheat, at a particular price on a particular date, so let us say after 3 months, if he finds another person who is ready to give the wheat at a lesser price, he may ditch this person whom he has already have a contract and go and buy the product from the other person. This is called as counterparty credit risk. Secondly, what can happen is, the person who has to pay the money after taking delivery may not pay the money at all. So this is called as counterparty credit risk. Now, who are the people who involve in the forward contract, which is basically a over the counter contract as mentioned above, with the characteristics which we have just discussed and analyzed? These people can be corporations, very big corporations who are hedging their exposures. I will explain how corporations hedge their exposures. Let us assume a particular manufacturing company need copper. Now, the present price of copper can be 100 rupees per kg, or let us assume for the time being it is 100 rupees per kg. Now, the company feels that the cost of the copper after 3 months or 6 months may increase. So, what do? They enter into a contract with another supplier who is ready to give the product after 3 months at a particular agreed price. So they are hedging the increase in the price of the copper in the next 3 months or 6 months by entering into a contract for a particular price which is agreed upon between these two people. So the corporation is now hedging the increase in the price of the copper over a period of 6 months by entering into a forward contract. Even financial institutions as dealers, they also like to hedge their position. Let us assume that a particular mutual fund or any other financial institution is having a portfolio. Now, if the company believes that in the near term there is going to be a downside in the market, so they would like to hedge their portfolio. How are they going to hedge the portfolio? They are going to hedge their portfolio by, you know, shorting the future contract of the index and keeping the portfolio as it is. So any decrease in the portfolio will be taken care by the short position with the which a financial institution has entered into with a futures contract. Now let us see the third people who are going to participate in forward contracts are sophisticated investors. Generally sophisticated investors means people who, for example, if you say, people who are dealing with gold, jewelers and all, they are all sophisticated investors. So generally they get involved in this over the counter forward contracts. And international trade entities, which we generally know when you are trading, having a trade between two different countries, so the international trade participants may hedge their positions using the forward contract. And finally, the last point which we would like to mention with respect to forward contract is that it has got limited regulatory oversight. What do you mean by regulatory oversight? Oversight means observation. So nobody is observing the contract which is happening between two people in a forward contract, because it is generally a over the counter contract. So when the contract fails, these two entities who have entered into the contract cannot go anywhere to get a justice. That is called as regulatory oversight. So in over the counter contracts, there will be no regulatory supervision happening. So whenever there is no regulatory supervision not happening, it is known as there is no regulatory oversight. Oversight means supervision. Now let us see what are future contracts and what are the characteristics and participants in the futures contract. See, future contract is generally a standardized forward agreement traded on an organized exchange. It means you have an organized exchange like the National Stock Exchange, and it is generally managed and controlled by Clearing Corporation of India, which manages the buying and selling, the Securities and Exchange Board of India, which frame rules and regulations and monitor the activities of the participants of the futures contracts. So here the exchange acts as an intermediary, and it will guarantee the performance of the contract also, the pricing mechanism also, and the clearing house which is available ensures that the agreement which is happening between two people using the future contracts are adhered to and it is respected, and the settlement happens very smoothly. So the future contract has this special characteristics of ensuring that the contract between two people is monitored and the execution of the contracts will be smooth. So let us see what are the main characteristics of the future contract. Here in future contract, there is a standardized specifications. What does it mean? The contract sizes happening between two individuals or two entities is fixed. Suppose if somebody wants to enter into a let us say Nifty 50 index, then there will be a particular lot size which is available, which may be 25 or 50 or 75, whatever is the contract size. Similarly, if you want to enter into a future contract with a stock like Reliance, the contract size will be, the lot size will be fixed. So here there will be a standardized specification with respect to contract size. There will be a standardized specification with respect to delivery dates. Like there will be a future contract for quarterly future contract, monthly future contract, 6 monthly future contract or yearly future contract. So these dates are determined. You cannot have a delivery dates of for 40 days, 35 days like this. It will have a very standard delivery dates. Suppose if you are entering into a futures contract for commodities, the quality of the commodity which is traded will be specified. what type of commodity, what should be the quality of the commodity. For example, if we take gold, so then they should very specifically mention what will should be the purity of the gold. So the quality specifications are very well defined in case of future contracts. That may not be, that is not the case with respect to the forward contract. Here in future contract, the delivery locations are specified, especially not in the financial contract, because financial contract is everything is done on the dematerialized form. Whereas in case of commodities, the delivery locations will be specified. But in case of over the counter contract, OTC contracts like forward contract, delivery locations may differ. Now let us come to the infrastructure available for the trading of the future contract. So in case of future contract, there is a centralized trading platform. For example, you can think of commodities trading platform, or you can think of national stock exchange where financial products are traded. So there will be a number of trading platform for trading the financial contracts or the commodities contract. There will be a clearing house available. The clearing, what is the job of this clearing house? This clearing house is a organization where it takes the orders from the buyer. That is, somebody wants to buy, they will clearing that person has to deposit margin money with the clearing corporation. And if somebody wants to sell, so the seller should also have to keep some margin money with the clearing corporation. So this margin money will help in reducing the default of any payment he made, which is going to happen either in the case of a buyer or in the case of a seller. There is a transparent price discovery available. What do you mean by transparent price discovery? See, most of the future prices, whenever the market opens, is available through various trading platform like Zerodha, Grow, Upstocks and all. So the price is available to a person who wants to buy or sell. At every minute, not even minute, every second, the price change which is happening is available to the trader. Hence the price discovery is very transparent. Because of this transparent pricing mechanism, there will be a what do you know price discovery? What is the meaning of price discovery? Means, since there will be number of buyers and seller, the price will get settled at a very optimum price, instead of in the over the counter market where the two persons entering into a contract, the buyer may not be available what is the actual price to pay. But here there will be so many buyers and sellers trading on the platform, quoting their prices. There will be a transparent price discovery happening. Now regulatory oversight have already explained. Here there is a Securities and Exchange Board of India, National Stock Exchange, who are going to closely monitor the trades happening between the traders through the exchanges like the National Stock Exchange, and the clearing house as such will be available to ensure the safety and guarantee of the trades which are happening. The next point is the daily settlement. What do you mean by daily settlement? Here, the contracts are marked to the market daily. It means every day the purchase price with the price on that particular day is compared, and if there is a if the suppose, let us assume that a person has taken a long position in a futures contract at 100 rupees. So after the trade happening the next day, if the price settles at 110 rupees, then the seller should immediately pay that 10 rupees to the buyer of the who is taken a long position in the contract. Similarly, suppose if the market settles down to 90 rupees after a person has taken a long position in a futures at 100 rupees, then there is a loss of 10 rupees. So the buyer has to deposit 10 rupees to the seller of the that particular contract. So seller will get benefited. So that is called as mark to markets. So every day the money gets transferred between buyer and seller based on the daily closing prices of the future stock or future indices. Here margin requirements is enforced. It means there will be various amount of margin money, initial margin, emergency margin and all. So we will describe all those and discuss all those margin in the future slides. So there will be margin requirements. So based on these margin requirements, the trading happens, and this whatever the loss or profit happening, that mark to market is settled using this margin money only. So there is variation margin calls will be there in case if a person consistently goes into a loss, and if his margin money gets depleted, then the National Stock Exchange will ask for additional margin from the trader. That is called as variation margin calls. Here the risk of default is minimized because every day the trade is settled, and the person who is in the profit will get the money on that particular day only, and the person who is at loss has to be at loss, and his margin money gets utilized. So let us compare a forward contract with a future contract. Okay, now in forward contract, you can tailor to specific needs. So customization is possible in case of forward contract, whereas in case of future contract no customization is possible. All the contracts are the lot sizes are already set, so there will be no change in the contract sizes, and it cannot be tailor made to individual specific needs. Here the settlement happens only at the end of the contract period, whereas in case of future contract, it is settled daily basis based on the mark to market concept. Now, in forward contract, the bilateral counterparty risk exposure is there, whereas in case of future contract, there will be no credit risk because there is a clearing house guarantee which is available, which ensures that the buyer and seller should keep adequate margin with the clearing house to take care of the daily mark to market transactions. In forward contract, since the contract is happening between two people, there is no liquidity available, whereas in case of future contract, thousands of people will be participating in the market using the future market apps like Zerodha and Grow. Therefore adequate liquidity is available. In case of forward contract, the pricing is negotiated between two people, whereas there is a very active pricing mechanism, transparent pricing mechanism happening based on very advanced sophisticated software of the National Stock Exchange, which determines the price of a future contract. In forward contracts, there is no regulation. There is very minimal regulation available, whereas in case of a future contract, it is regulated by the National Stock Exchange, Securities and Exchange Board of India, Reserve Bank of India and others. Whereas in case of commodity, it is CFTC exchange rules is applicable. So let us analyze the future market now. So as we have described, what is a future market? A future market represents standard financial contracts to buy or sell an asset at a predetermined price on a specific future date. So who are the participants of the future markets? Future markets participants are generally hedgers, as I have explained, traders and speculators. So as we have discussed, the future markets are monitored by Securities and Exchange Board of India, There is something called as investor protection, market integrity will be there, and major exchanges of the futures include National Stock Exchange, Bombay Stock Exchange, and commodity and forex exchanges also. See, we'll just go through this Indian futures market. In 2000, the Indian index futures were introduced by the National Stock Exchange with Nifty 50. And in 2001, single stock futures were launched. See, index futures are different and stock futures are different. Just the way you do futures trading in the index, you can do futures trading in the individual stocks also. And finally, in 2008, currency futures trading was started with US INR pair. Now there are many other pairs available, that Euro INR, Japanese Yen INR, and other contracts are also available. In 2010, interest rate futures was introduced for debt market hedging. We will discuss interest rate futures in a separate video because it is a very vast subject on its own. In 2018, there was an enhanced surveillance and investment protection measures which was implemented based on the various inputs received during the various crash and market volatility which happened from 2000 to 2018. So let us understand what is a position limit in future market. See, position limit, we can generally consider it as a regulatory restriction. So what is a regulatory restriction? See, it means the Securities and Exchange Board of India ensures that a single trader a single entity does not hold majority of the future contracts, so that he can control the market. So in order to ensure one single organization, one single financial institution, or one single entity will not be able to either manipulate the market or take control of the market and hold monopoly in the market, usually position limits are set. Positions limit will help you to ensure market integrity, fair pricing, and protection against corner position, means generally to ensure that manipulation of the market. So let us see what are the purpose of position limits. So position limits prevent any single trader from gaining excessive influence over price movements. That's what I just said. One person should not be able to manipulate the market. Position limits ensure many participates in the market, and hence it will result in adequate liquidity in the market. So position limits generally ensures reduction in the systemic risk by limiting concentrated exposures that could threaten market stability. So all these points we discussed just now. One is, what is the purpose? Just to ensure adequate liquidity in the market. Second, to ensure that one entity or one company does not hold majority positions in the market. By holding majority position, they will be able to manipulate the prices of the futures. Hence, in order to avoid this manipulation of the futures market by a single trader, these position limits are generally given. Now, what are the types of position limits? Let us understand. There is something called as individual position limits. It will apply to single clients. And there is something called as aggregate limits. It will cover all positions held by an entity, including its clients. And we have something called as special limits, which exist for hedgers. We see hedgers are generally given more position limits because they are genuine people who would like to hedge their current positions, and they are not there to do speculative trading. Hence, hedgers generally get a higher position limits compared to traders and speculators. See, hedgers also require futures contract for risk management purposes. Hedgers basically include pension funds, mutual funds who are holding very huge portfolios, and they may require future trading in order to manage the risk properly. Let us see what is the position limits for equity futures. See, for equity index futures like Nifty 50, the position limit is generally 15% of the total open interest. Open interest, you should know, open interest is nothing but number of the total number of contracts which are open in any particular exchange. So it says 15% of the total open interest or rupees 500 crore, whichever is highest. So it says this is the position limit for mutual funds, foreign portfolio investors and foreign institutional investors. Whereas in second case, rupees 7,500 crore or 15%, whichever is higher for trading members. Who are the trading members? Trading members can be Zerodha, trading members can be Upstock, trading member can be ICICI Direct. So this equity future limitation which has been put ensures that no single entity or no single trading member can dominate the market. Now coming to the currency future, see, currency derivatives have a position limit of $10 million across all currency pairs. So for every currency pair included, the maximum position limit is $10 million, with higher limits available for genuine hedger, as I have already explained. Now, client level limits is lower of 1% of free float market cap or 5% of open interest. I have explained open interest, that is number of contracts open. Free float market cap means, see, market capitalization is based on the total number of shares, outstanding shares in the market of a particular company into the price of the stock at that particular day. However, some of the companies may mortgage their shares held with them. That is, owners or the promoters can mortgage their share. So those mortgage shares cannot become part of they are not meant for selling. So total number of shares, outstanding shares of a particular company reduced by the number of number of shares which are hedged by the promoters becomes the free float market capitalization. Let us assume a company has 10 crore shares, out of which the company has mortgaged 1 crore shares. So the company is left with only 9 crore share. If we assume 10 rupees as the price of the one share on any particular closing day, then the free float market capitalization is 9 crore into 10 rupees, which becomes 90 crore, because the other 1 crore shares of the company is mortgaged with any bank or anything for getting the money from the bank. Now let us understand the limit for combined gross, limit for foreign institutional investor and FI. So for FIA/FIR, combined gross limit is $6 billion across all equity derivatives. See, monthly monitoring and reporting to exchange will be there, whereas in case of currency futures, the hedgers can take positions up to their underlying exposure. Whatever exposure which is there, they can take positions based on the limit set by the Securities and Exchange Board of India. Trading members, as we have explained here, that is, they generally have higher limits. So these limits will apply across all exchanges. We have got National Stock Exchange, Bombay Stock Exchange. So this limit is applicable not separately for NSE and BSE. So whatever the position of a particular broker like Zerodha having position in both Bombay and National Stock Exchange, that combined positions will be taken as a position limit. It is not individual will be given separate 15% or 5% or 7,500 crore as we have just discussed. We will discuss margins in futures trading in our next video.